Hey soldiers, Bank of America is out there saying that things are going to get really bad next year in terms of several financial metrics, several economic categories. This is going to affect you one way or the other. Now, they have a suggestion that they're making, but you got to keep in mind this is a bank, this is a major financial institution, and what they recommend you do may actually advantage them and disadvantage you. So let's see what's going on here. Bank of America analysts are warning of a collapsing U.S. labor market and a potential rise in unemployment next year. They also recommend selling a stock market rally ahead of the likely surge in job losses. Quote, "Bears like us worry unemployment in 2023 will be as shocking to Main Street consumer sentiment as inflation in 2022. This is according to Michael Harnett. He's a strategist over at Bank of America. He also revealed that global equity funds are having their biggest weekly outflows in 3 months. So big money is selling. Now, big money is different from our money. Okay, and I'm going to go into that a little bit here. You've got to figure out what your investment objective is. If you sell into a falling market, it's quite possible that you may never recover those losses depending on your time horizon, your investment time horizon. So let's say that you are nearing retirement. If you are, should you really have the type of asset allocation that a 20-year-old has? Okay, someone with a lot of time horizon left. The retiree is going to need to put that money to work building income, okay, in the years that they're not actually employed or running a business. So these are things you need to consider very, very strongly before you have a knee-jerk reaction. Again, proper planning over time. Again, that 20-year-old that just started working last year, it might be that the best thing for her is a down market where she's dollar cost averaging into on a regular basis, and that's going to hold her in good stead in the decades that she has generate money to invest. Now, for the 60-year-old who's coming out of the work world in a couple of years, that equation is completely different, as my dog is very animated about that, and you might be able to hear him second what I'm saying to you. Now, speaking of outflows, we do have another report about Blackstone, not to be construed with BlackRock, different company, same kind of, skilo, same kind of modus operandi in terms of investing. But Blackstone has recently limited investor withdrawals from a $145 billion REIT as economic concerns grow. Blackstone has limited withdrawals from its non-traded real estate investment trust after a large number of investors sought redemptions, making it the latest firm to take such a step as global economic concerns grow. Blackstone Real Estate Income Trust, also known as BREIT, B-R-E-I-T, allowed investors to withdraw $1.3 billion in November. That represented about 43% of redemption requests it received, according to a report by the Financial Times, citing a notice that the private REIT sent to investors on Thursday. BREIT had nearly $145 billion in total assets as of September 30th. So we're seeing the big money again coming in and saying, you know what, let's grab some of this money out of this market and, flight to cash. Now, this could be happening for a variety of reasons. You might have margin accounts being called where people have borrowed money to purchase assets, and now that the value of those assets have slipped to a certain point where the loan is being called, and you have to make good on that loan. So that's one reason you could be seeing this big money go ahead and trade assets for cash. Another reason is because they're just concerned about, again, the volatility, the coming turmoil, and it could also be that they feel as though they made good money with whatever it is they've been in. So they're going to come out of it and try to buy back into that asset or maybe even another asset for less. Now, it's important to note that with this Blackstone REIT, we're not talking about any malfeasance. Yes, they have suspended withdrawals, but this is something that they laid out that they would be able to do and may do at certain points. This is laid out. It's not a surprise to anyone. Investors can redeem in this Blackstone REIT. Investors can redeem up to 5% of their 5% of their holdings per quarter, at which point Blackstone can limit withdrawal requests to prevent a forced sale of its real estate holdings. Now remember, they are making money by the rents that are being paid. This particular REIT is holding properties that are residential and of corporations. So they want to keep the asset. They don't want to have to liquidate so much in terms of money because people are coming at them for withdrawals that they have to end up selling the asset. Because remember, real estate is not liquid. It's not something that is going to, sell in trade plus 2 days. All right. So in order to prevent that, they wrote this into the terms. And so it's not a surprise. This is nothing nefarious in terms of them, cutting that off for now. Now, another reason why this is occurring, it comes as real estate investors express concern about how rising interest rates and an economic slowdown would affect commercial property markets. The Federal Reserve has raised interest rates to record highs, as you all know, this year as inflation remains at relatively high levels. In response to increased requests for investors to take some of their cash out of the fund, Blackstone said BREIT has had a strong performance in large investments in multi-family and industrial real estate, two of the industry's strongest sectors for several years running. All right, so that's going on in the property sector. And then we go and we, look at what Bank of America has been suggesting. They're continuing to say the strategist outlook is similar to their peers at JP Morgan and Goldman Sachs. So they're all having this kind of same idea. They've warned of a potential economic recession next year. Now, we're already in a recession. We went over that ad nauseum. You can view some of the videos that we've done previously on the subject. Yes, it looks like the recession may deepen, which, in some ways could be a positive if you're looking to pick up assets on the cheap. Equity funds to see an outflow. Global equity funds saw $14.1 billion in outflows in the week through November 30th, led by exits from U.S. stocks, the biggest weekly outflow in 3 months, according to the Bank of America strategist. They also said that $6.1 billion was being withdrawn from exchange-traded funds and $8.1 billion from mutual funds. So, the floodgates are open here. People are selling out. Is that a good idea for you? You've got to review your investment objectives, your strategy, what you're holding, and you got to figure out, hey, is this something that I want to just ride out? Okay, maybe even purchase more during the trough, or am I going to need this money? Am I, looking at a situation where I've got this account over here that's not a qualified account. So if I liquidate any portion of it, I'm not going to get hit with taxes and penalties like you would with a 401k. Hey, if it comes down to you having to eat, all right, or holding on to a stock, I guess the choice would be obvious. American-based large cap stocks, these are the big companies, the behemoths. We're talking about AT&T, we're talking about Amazon, big old companies like that. Large cap stocks had outflows of $14.5 billion. This is November we're talking about, with U.S. small cap stocks, growth and value funds also seeing redemptions, or folk coming to them and saying, I got to trade this in and get some money from it. Okay, then they go into the labor market, which is the driver here because America is a consumer economy. The labor market still looks strong for now, as 263,000 non-farm related jobs were added to the American workforce in November, far more than the expected 200,000, according to a December 2nd government report. Now, look, I have long said I don't trust. You got to really sift through this information. Like, for example, in previous reports, we've covered the fact that many of the jobs being created are part-time jobs or second and third jobs. Okay, so that is nothing to cheer about when a substantial portion of the jobs that were gained are jobs that are now Americans are holding multiple jobs just to make ends meet. That's definitely nothing to crow about. Meanwhile, average wages rose 0.6% over October, 5.1% more than the same period in 2021. And the price of chicken is up over 2%, 10% rather. So, there's still that disparity. The U.S. unemployment rate held steady at 3.7%. Again, they're looking at the U3 rate, the broadest measure of unemployment as published by the Bureau of Labor Statistics is the U6 rate, and that still is in the neighborhood of 7%. All right, and the Fed has indicated that he's going to decelerate the pace at which interest rates are being raised, but he hasn't said he's not going to raise interest rates. So again, we're dealing with a situation where money's getting more expensive, which is putting pressure on employers and small businesses, all businesses, to retain employment because they're not necessarily going to be able to get the business because, again, money is becoming more expensive. So we've got the interest rate rising. We've got inflation still at elevated levels. All right. So this is we're going to see some pressure on the American consumer. So guys, I want you to figure out a way so that you can stay in your home, so that you can continue to feed your family. These are the priorities. I know the Christmas season is coming up, and a lot of Americans go hog wild when it comes to Christmas shopping and all this and that. And hey, look, little Timmy, because I grew up dirt poor. And guess what? It was made clear in no uncertain terms that Christmas would be about family. We'd have a meal and we'd, get together as a family. And the family would come over from different parts of the town and whatnot. And that was what we did. Okay. Now, sure, we did have, we got one gift, right? We used to go over cousins' houses, and God, the tree was like damn near up to midway the tree with gifts. God bless them. I never felt any way about that. They're cool people. They just had a different circumstance, right? So what I'm saying is, at the end of the day, you know what we had? We had full bellies and we had shelter, okay? And I'm just, hopefully you're in a better position than just having subsistence level existence. But at the end of the day, there's a lot to be grateful for when it's not raining on you and you are not starving, okay? And I hope your Christmas is a lot, more abundant than that. But I would ask you to just be the ants, not the grasshopper, okay? Store up something so that you have something to fall back on. And also remember someone who is less fortunate. Drop some food off, at a kitchen that feeds the people, or some clothing or something like that, because we got a lot of Americans out there hurting bad, man. Sleeping on the streets. I still can't believe that we got folks sleeping on the streets and we're sending billions to Ukraine. But homeless outreach and help, a lot of times that's a racket, and we'll go over that in great detail. Sure, you have some altruistic people out here whose hearts are in the right places, but then you have other types of people who see others' unfortunate happenstances as a financial opportunity. All right, guys, so that's what I want you to do. Take a look and make sure you're positioned well for what we've got coming down the pike. And in the meantime, speaking of banks and banking, I want you to check out this video. It's about another product called Marcus by Goldman Sachs. We did a review of this, and it's a savings product that could maybe help you supercharge your savings and get that emergency account in good order. Check it out, see what you think, and guys, I'll talk to you soon. Like, subscribe, comment.